Alrighty, folks, we are in earnings seasons. Thus far, it's been very much banks and financials. I think we have something like 30 or 35% of the S&P and Dow reporting this week. A lot, I think like 70% over the next couple of weeks. I thought I would ask Taylor from Life Goal Investment, what has he seen in the earnings thus far? What is he hoping to see in the next 10 business days? Taylor, what's going on?
This week is probably the week when it comes to earnings. It starts tomorrow, Microsoft and Google. And then on Wednesday, we have Facebook and Meta. And then on Thursday, we have Amazon. I think those days are right there. They're right in there. But nonetheless, you're looking at the second and fourth largest companies reporting tomorrow in the world. Facebook is currently the 8th largest company, and Amazon, I believe, is the 5th largest company in the world. And the other thing about these companies is that the 4 of them are huge, obviously, components of the S&P 500. They're about 15% of the S&P 500. They're over 30%. Companies reporting this week are over 30%, just those 4 companies I named, of the NASDAQ. And so it is massive, disproportionate effect on the market. And these companies are really, really economically sensitive. So not only do they drive it by their own stock price moving predicated on their earnings results, but it's also people going, oh, that's what they reported. Well, the economy is going this way or this way based on it. And we'll reprice all stocks across the board.
Yeah. And I think those stocks have been disproportionate. I think 6 to 10 stocks have kind of done the lion's share of the heavy lifting for the year, right? People are talking about the NASDAQ and being up for Q1. It was really 6 or 8 or 10 stocks that were up.
Correct.
That carried the market.
Yep.
So this could be an inflection point.
Oh, yeah, absolutely. So it was NVIDIA was up like 80 or 90%. Amazon was up huge, 50% somewhere in that ballpark. Tesla was up somewhere in that ballpark. I'm sorry, Amazon wasn't up 50. Amazon was up like 20. Tesla was up like 50, 60. Now that's obviously come down recently based on some of their earnings. And then the other big one's Apple, because it's such a big constituent, was up 20% or somewhere in that ballpark. But it's funny. So we've now granted, this is only 13% of the companies have reported earnings from the NASDAQ. But if you weighted average those 13 companies out and annualize it, it's showing a negative 27.7% annualized earnings reduction.
Really?
27.7% earnings reduction. Massive. So earnings are ugly, especially in that NASDAQ tech heavy sector thus far. This week is when we're getting the biggies. Now, Apple doesn't come for a couple weeks, but this week is probably the week where you start to get an idea of some of these really economically sensitive tech companies. How are they performing? And I think what you want to watch is margins, because these tech companies have already obviously saw massive layoffs. Have they cut enough to bring their margins in line with where they want them to be, or are their margins still really thin, implying that they're going to have to cut again moving forward?
I'll answer that for you right now. They will be cutting again. No tech company, and I've been in the Bay Area for 50 years, right? No tech company cuts deep enough or fast enough.
Right.
I've been very clear. Most of them will have at least 3 rounds.
And I think it's an interesting perspective, and I think it could be amplified even further based on what happened during COVID. So COVID, obviously, there was a talent shortage, and therefore it was called talent hoarding. They said, "Hey, we'll bring you on." Yeah, we don't even know that we have a perfect role for you right now, but our business is exploding so much during this COVID period when everyone was working from home, getting stuff delivered, yada yada, that we'll bring you on. We'll find a role for you. You're talented, and obviously the economy has taken a turn, and now they're looking at those people and saying, our margins are razor thin right now, and we need to start to find profitability. And how do you do that? You cut costs if you can't control the output on the other end.
Yeah. The other thing that I thought was interesting, total, right turn, we'll see how we do on this one, is Procter & Gamble and Coca-Cola, right? Procter & Gamble, I think, reported Thursday, Coca-Cola this morning. Both of those are kind of, refrigerator and cupboard stocks.
Yep.
Both of them beat bottom line, but buried in the numbers is they beat because they raised prices, right? Procter & Gamble's shipments, I think, were down like 3%. Unit volume was down. I didn't catch Coke's. I didn't read it in detail this morning, but again, a lot of them are beating because they've raised prices. And I thought that was pretty interesting.
How does that affect the consumer on the other end?
Exactly.
You already have, that's pressing inflation higher. Wage growth right now is not keeping pace with inflation. And that's, dwindling the pockets of the consumer, who is then supposed to go out and buy more things. Like there's a feedback cycle here, guys. This isn't, the first time we've seen how economies work. Things get overheated, the Fed raises rates, takes, debt financing super high, and people can no longer afford things, and that forces a rollover in the economy. I mean, this is kind of textbook how it plays out. Now, everyone doesn't look the exact same, but this is the business cycle.
Yeah, exactly. Going back to earnings, right? It obviously started with the big banks, the big four, the big five, six, whatever it is, kind of exceeded expectations. Generally speaking, they had record net interest margin, which again, you don't need a lot of head count for that. All of them increased reserves. Go ahead.
And it will also potentially go away, net interest margin, if we do get compression on yields, or if we do get a slowdown in our economy, the Fed's going to cut rates. That will bring their net interest margin down dramatically, and it happens overnight like that.
Yeah. A lot of them are writing off loans. A lot of them are increasing loan loss reserves. I didn't get a great picture on loan volume other than to say it was down. I think a lot of that will be reported in Q2.
Yeah, because the SVB blow up happened so late in Q1 that it probably, affected the last couple weeks of the 12-week quarter or whatever it was.
Right. Exactly. Well, then let's talk about the regional banks. Again, lots of regional banks have been reporting, generally speaking, not good would be kind of my summary. What do you think?
Yeah, you're 100% on. And this is, again, without the real effect of Silicon Valley Bank having thoroughly played out. I mean, it only played out for a couple weeks there, but it was a fast and swift move that people did to make, to take money from one bank and put it in another. So it'll be interesting to see, again, to your point, what happens in Q2. But stock prices generally are forecasting agents in the KRE, which is the regional bank index. It can't find a heartbeat right now. It's down 40% or so, and it cannot find that bottoming point to say, all right, we have some confidence back in the system. The Fed stepped behind us and said they will back all bonds and buy all bonds at par value in order to make our liquidity profile better than it currently is. And they still didn't catch a bid after that. That's a scary thought.
Well, you know what? We're going to talk about it in the next episode. Probably the most picked on or most focused on regional bank, which is First Republic. They actually report after hours today. I just want to kind of look into the future and see what we're seeing. But before we do, where can people follow you?
Yeah, follow us at Life Goal Investments. We're on both Instagram and TikTok, putting out stuff daily that tries to take it one level deeper than what most people do.
And you make it entertaining. And occasionally we get a rant, which I particularly like, is when you just go off and rant. So keep it up, man. Keep it up.
Appreciate you, Michael. Thank you.